Hello there, my friends. Chris Marcus here with you for the StockPulse Network on Thursday, October 11th. And I'm really excited this morning to have a guest on from the Mises Institute. We have Jeff Deist. And really, for those who might not yet be familiar with the Mises Institute, when I was back in New York trading options and realizing that the world was not quite constructed as explained in Wharton Business School, Mises really became my Bible when I would come across economic concepts and started to realize, I wonder how this actually really works. And Mises is a great resource for that. So Jeff, it's a pleasure to have you on here today, and certainly with a lot of exciting things happening in the market. Great to have you on and get your take on what's going on, so folks can understand how the Austrian theory is not just theory, but is actually being applied and really make quite a difference. So just to get started, how are you this morning, my friend, and how's everything going?
Well, I'm great. Everything's great. Not so great on various stock market indices this morning, but there's good news. A bargain. You can get yourself a share of Amazon for only $1,718 right now. So they're down about $40, down 2%. So, if any of your listeners have read David Stockman, Amazon is a particular boogeyman for him.
Right.
And really, Amazon is really an interesting test case, I think, in a lot of ways, and it challenges a lot of Austrian orthodoxy. In other words, what's a company there to do? Well, in the old days of 20, 30 years ago, companies were supposed to make money. They were supposed to pay dividends to their shareholders, and you weren't just buying stock so that you could sell it at a gain years later. You're supposed to make money in the meantime. Just like if you have a dry cleaning business, you need income in the meantime, and then maybe, hopefully, someday you sell your dry cleaning business. What's so amazing about Amazon is it has been a public company, a listed public company for over 20 years. And basically doesn't make much of a profit. A few years it's had a small profit. It doesn't pay dividends, but yet it came up with $13 billion with a B, $13 billion in liquid cash to buy Whole Foods, which is, a grocery chain. We're talking about physical stores. We're talking about inventory. We're talking about thousands of employees. We're talking about a traditionally low margin business. So tricky business. And I'm sure Amazon can handle it. Don't get me wrong. I'm not bashing Amazon, but a tricky business. If I was an Amazon owner, and we all wish we had been at $18 when it went public, I'd be wondering why do you have $13 billion to buy Whole Foods with cash and you're not paying me a dividend? So, I think what we're going to see in the next few years is whether the David Stockmans of the world, who can be derided as a perma bear, are right, or whether we really have reached sort of a new era. Peter Thiel in his book says we shouldn't look at PE valuations. We shouldn't even look at earnings right now. We should determine the value of a company based on the sort of the future, the current value of all the money it's going to make in the future. And maybe Peter Thiel's right. Maybe by that measure, Amazon is such a beast that it's still a bargain at $1,700. It's not a bargain to me, but Peter Thiel's a lot smarter and richer than me. So it's a very, very interesting time to be in markets, and a scary time, which means some people are going to get rich in the next few years.
Yeah, certainly, especially in my opinion, if you understand what Ludwig von Mises was saying, because especially waking up, seeing the big drop in the market yesterday and today. Again, I missed the 2008 crash, was the one that opened my eyes and led me to understanding the Austrian theory. And it's really fascinating that it's going exactly as you would predict. You have the lowering of the interest rates, all the extra credit. And I mean, we don't have to take your opinion or mine. We have Ben Bernanke himself, who wrote that incredible op-ed back before he launched QE2, saying the whole point is to give the appearance of wealth, which they certainly did. And now you have, like you point out, companies that maybe one day they'll be making a lot of money. A lot of these tech companies burning through cash, yet the market just continuing to rise. Although now with interest rates going up, I don't think it's an accident we're seeing the real estate market slowing down. Whether what happened yesterday and today is just a warning and we have another year or two of daily new highs. But I'd love to get your comment on that, of how, especially for folks who might be hearing about Mises for the first time, just how it's playing out exactly as the credit cycle as understood by the Austrians would indicate.
Well, we have this term, the business cycle, which implies that industry creates these ups and downs, recessions and boom times. But in fact, it is, as you suggest, a credit cycle. In other words, from the Austrian perspective, we can look at what central banks do, and we can blame the coaster of ups and downs in the economy essentially on central banks. Someone who's not as familiar with this theory, with the idea that there are credit cycles and boom and bust cycles that result, might say, well, why don't central banks just do whatever it does that creates a boom and do that always and forever? Well, you know, that sounds good, but it's a little more complicated than that, because at some point, if you don't have these little things called interest rates, if you don't pay people to save or invest money, they won't do it. For the Keynesian orthodoxy, which is still mostly the predominant economic perspective on both the left and the right today in the Western world, in the Keynesian orthodoxy, that's great. You know, the entire project of economics and fiscal and monetary policy is to stimulate demand for stuff. Right. Consumption is the key to the entire economy. And if we just get people to want to buy a lot of stuff, then we'll all be rich. The problem, of course, is they have to have some actual money to buy this stuff, which means they have to have employment or income, which means that there has to be some productivity in the economy. So one thing which really distinguishes Austrian perspectives from Keynesian or monetarist or Chicagoite perspectives is that production is the key. We have to look at how productive the economy is and whether capital is actually being accumulated in the form of profit. Because if you look at the whole path of human history, economic growth has been the result of people producing more than they consume. Right. So they take that little extra and that becomes profit, and that profit accumulates, and they use that accumulation to invest in capital goods, which make it so that they could have machinery or technology or soon, you know, AI to provide goods and services more economically, cheaper. So the history of humanity getting richer, coming up out of caves into these wonderful modern societies we enjoy today, and all the material wealth around us, is that people accumulated capital. We could even say that progress means capital accumulation. But yet the whole project of central banks in our current era is to get us to consume, to take on more debt, more borrowing. And so when I look at this overheated stock market, or what was, at least until yesterday, seemingly an overheated stock market, we have to wonder, where's the organic growth? Where's the increase in profitability? Where's the increase in new markets? You know, we see a lot of stock buybacks, we see a lot of financial engineering, but are there really companies that are growing and expanding in the truly organic sense? Or are they just simply responding to a low interest rate environment? And that's very frightening. If we think, or if we even consider, that all the stock market health of the last 6 or 8 years since the crash has been the result of a low interest rate environment and financial engineering, tinkering by the Fed, rather than actual organic productivity increases by the companies listed on these exchanges. What if it isn't real? That's a scary thing for investors.
Well, I think so. And I mean, I like to keep an open mind and examine all possibilities, yet over the past decade, I've found it hard to explain this rally otherwise. You know, here we are, we're 10 years later. If the economy was great. Why are we still at 2% interest rates? And thinking back to what happened leading up to the last crisis, we had Greenspan take rates down to 1% for a year.
Right.
And when he tried to undo that, we got the subprime bubble. And if I remember correctly, I think his last rate hike in 2005 or 2006, I believe he brought short-term rates. The last one was up to 6.5%. And we're already seeing trouble now when the Fed's short-term interest rate is at 2%. And then to put that even further in perspective, we had Paul Volcker back in 1980. If the bubbles then required a short-term interest rate of 20%, and now we have 21 trillion of debt, not including, and I'd be curious, I know you guys calculate some great numbers. Here, Lawrence Kalitnikov mentions if Congress were not committing accounting fraud and actually doing the same exact thing as Enron with Social Security and Medicare, he calculates at I think he had a number of 222 trillion. That was a couple of years ago. So when you talked about the fastest growing companies, it's really the U.S. Treasury and the debt load. That's the fastest growing one. And it's bizarre because it doesn't even seem like there's any attempt to do anything about it. You hear the budget projections. They're not talking about cuts. They're already talking about when we hit 30 trillion. And I know in your background, you've done some work with Ron Paul, who at least was one of the few people trying to actually get this addressed. So I'm curious how you see this playing out. I go back and forth wondering, is the Fed just clueless, or are they just darn well aware of what's going on and they don't care? Curious to get your take on that, Jeff.
Well, I don't think they're clueless, but I think that they're political. And I think that they are kicking the can down the road. In other words, allowing us to live another day at the expense of the more distant future. And you mentioned Paul Volcker. He really should be applauded as the last Fed chair who was willing to go against the administrations in front of him, and fight them and keep interest rates high, because presidents always want low interest rates because it produces an artificial boom business. But we have this sort of complicated relationship now between interest rates, the national debt, the federal budget as engineered by Congress, and of course entitlements in the future. All of these things are interrelated, and it's a little complex to understand them in a political world where people want sound bites. They want politicians to tell them happy things. Politicians who tell them unhappy things don't win. So when we consider Mr. Kotlikov's work, he's basically saying, and he's no radical libertarian, he's basically saying that what we've promised to pay people in the future in terms of Social Security and Medicare, and what they're counting on, versus what we're likely to take in the future in tax revenues under even a relatively robust scenario, a rosy scenario, I should say. There's a $200 trillion gap, trillion with a T, okay? Yeah. This is a very unpleasant reality for a lot of people who are, let's say, under 50 or under 60, who are counting on living to 90 and having that Social Security check of $2,500 every month and having it be meaningful, not just nominal $2,500, but with some purchasing power. Right now, interest rates on 10-year treasuries are, in the 2 to 3% range, about 2.6%, which means that when Congress creates its annual budget, even with this debt of $21 trillion, the debt service, the interest payments on the budget are only about a little more than $300 billion a year, which is still a pretty small percentage of the total budget. But if we had interest rates in just historical ranges, like we did in the years of Mr. Volcker, if we had interest rates just in the 5 to 10% range, that number in the federal budget will quickly get up into the $700 billion range, which would mean that interest service on the national debt would be the single biggest line item in the federal budget. It would be bigger even than the Department of Defense. It would be as big as Social Security and Medicare. So all of a sudden, we're going to be taxing people and saying that your tax dollars, we're spending as much on interest as we are on Social Security and Medicare. That's going to create an impossible situation for Congress. So basically, Mr. Powell and the governors at the Fed are in an impossible situation. If they keep raising interest rates, they're going to slow down the economy. They're going to kill tax revenues, and they're going to create a real problem for Congress. If they don't raise interest rates, they're going to keep us in this kind of zombie situation where people are forced to go out there and chase yields because they can't earn much with just traditional safe investments, especially when people are older and they want less risk. That's why there's so much venture capital, because people don't want 2%. They want 5 or 7 or 8%. So they put money into funds that go out and chase yield. So it's not a fun time to be a central banker. And I don't think that they have any magic trick up their sleeve. I think you have to pay people a reasonable rate of interest. And if they do so, the federal budget's going to be in big trouble.
Yeah, excuse me. And that's certainly what Mises and Rothbard and all the other great Austrians were writing about, that you start distorting the interest rate curve or any sort of natural free market, and you always get these blowback consequences where, like you point out, you have insurance funds and pension funds that they can't survive on 0% interest rates. So what have they done? They've gone out seeking out riskier assets, which is exactly what we saw happen with subprime, and not expecting it to end much differently this time. Again, as you mentioned, I felt for a while that the Fed has likely gone past the point of no return, because now you can sit there and you can keep your 0% interest rates and hyperinflate the currency, which my best guess is some form of what they'll do. Although if you try and undo it, which in many ways would seemingly be more responsible, I don't think the system can handle it with how far it's been pushed these days. Although, of course, in any situation like that, there are always solutions. You mentioned wishing to be able to go back and buy Amazon at $18. And while we might not be able to do that, I'd be curious to hear your take on gold at around $1,200 and silver $14.50 now, which in many cases is below the actual cost of production it takes to go dig it out of the ground. Obviously, there's a lot of folks, myself included, who believe there's a lot of manipulation with short selling in the market. But I'd love to hear your opinion on gold and silver, perhaps where we go from here, and what, if that's still a wise way for people to respond to what the Fed is doing.
Well, I think gold and silver would still be an excellent choice for countries that are in trouble, like Turkey and Venezuela, to create some sort of advisory board that deals with their central banks and ties their currencies to something tangible. I do think gold and silver are probably undervalued, but even if I believe that strenuously, I'm not going to go out and have more than a pretty small percentage of my own assets in that, because it's not an asset that pays dividends. It's a store of value, and it's a form of money. But I mean, here's the thing: there's never been a point in human history, really, at least since gold has been used by humans. There's never been a point where if Grandpa died with a bunch of gold, it's worthless, right? I mean, it goes up and down, but you're always happy if you get some gold, let's say, when a loved one dies. Whereas, stock certificates and all kinds of land, all kinds of things can become completely worthless. So I think the idea that the gold standard is irrelevant in our modern age because of modern central banks, and then also because now of cryptocurrencies, I think is wrong. I think gold can still play and will play a very important role in the future. And I think even the IMF acknowledges this when they talk about including gold in a basket of currencies. You notice that what central banks do and what central bankers say are sometimes two different things. And central banks are actually buying a lot of gold and holding a lot more gold than people might imagine. So the question is if gold isn't money anymore, and if central bank fiat or cryptos have made it irrelevant, why are central banks buying and holding it? Well, probably because, at least on some level, they say, well, we don't really know what to do. Things are so uncertain, but here's at least one thing that we feel has some tangible value that we could always rely on and always have on our balance sheet as something positive. So, we don't know the future, but it is important to watch, I think, what central banks actually do. And it's very interesting to me that they're buying gold.
I've found that fascinating too, where we hear most central bankers sounding like Warren Buffett saying it's a useless relic, which, with all due respect to Warren Buffett, just has seemed odd to me, especially given my understanding his father Howard was a sound money advocate.
Yeah.
And I believe Warren Buffett was a large silver holder, which eventually led to the creation of that SLV fund. So I don't know how to respond to that one, although, again, it's similar to the banker mentality where Ben Bernanke gets up there, says he doesn't understand gold and nobody else does either. I would dispute that. It seems, Jeff, like you understand gold just fine. And in either case, if he really doesn't understand gold, should we be giving these folks the power to do everything they want with the money supply in the economy? Perhaps a whole other debate. Yet I think you raised some great points, and I really appreciate that Mises Institute and you are there, because there's so much information. That's part of why I left Wall Street, because when I started to read Mises and see how these things actually work, there was always a degree to which things I was learning on Wall Street and business school, I'm like, it doesn't seem to add up. So if in closing, you can just, again, let folks know, fortunately we have the banner there with the Mises.org address, but let folks know how they can get involved, any of the events or education programs you guys do, because I like to think it's a special time for people finding out that it doesn't have to be this Rubik's Cube. The Austrian Theory, when I started to grasp it, was always, it was just so beautiful to me, and seeing how economics work in a very logical fashion that when explained correctly. So if you can tell folks how they can find out more about what you guys do there, that'd be great.
Well, look, we've got a lifetime's worth of stuff to read at Mises.org. We have full-length books in HTML format. We have dozens and thousands of articles, books, videos, you name it. So you can learn as much about economics as you would want at your own pace and free of charge. But beyond that, I think it's just important to challenge yourself. Whatever your personal political or views are, your personal economics views are, I think we can all agree that there's no free lunch. There's no something for nothing, and that you ought to challenge yourself and read and learn about something that's going to have such a huge effect on all of us, especially if we hope to have some sort of reasonable retirement, and that we all hope that Mr. Kotlakoff's admonitions don't come true.
Yep. Well, thank you again for joining me this morning, Jeff, and for all that you guys do at the Mises Institute. I'm a big fan, will remain so, and reference you guys often, and it's an honor and pleasure to have you on here and give folks some insight. I think you guys lay out a great roadmap for what's coming, so visit Jeff over at Mises.org. And with that said, we'll wrap up for today, but hope you have a great afternoon watching the markets unfold, much like Mr. Mises would have predicted. And thanks again for being on.
All right, Chris. Thank you.
All right.